Most retirees don't run out of growth, they run out of paychecks. Returns look great on paper, but lifestyle lives on cash flow. In this video, I'll show you how I pressure test a portfolio's monthly paycheck against taxes, inflation, and down markets without chasing yield. If your plan passes this test, ownership, endurance, and order, returns become the bonus, not the lifeline. Let's start with the single number I look at before any performance chart. Part 1, ownership. Count what's truly yours after tax. Here's what catches people off guard. That 7-figure 401k statement isn't all yours. The IRS hasn't collected their portion yet, and they will, whether you plan for it or not. We call this your tax-adjusted net worth. It can dramatically change the retirement math. Say you've accumulated $1.2 million in your 401k, $400,000 in a Roth, and $300,000 in a taxable account. The statement shows $1.9 million. But let's run the real numbers. That $1.2 million in your 401k, if you're in the 24% tax bracket, and many retirees are, you could be looking at $912,000 after taxes. Your Roth is genuinely all yours, all $400,000. The taxable account might have $50,000 in embedded gains, taxed at a 15% capital gains rate, netting you about $292,500. Your actual spendable wealth, roughly $1.6 million. That's $300,000 less than what your statements show. And here's where it impacts your monthly paycheck. If you need $6,000 a month from your portfolio to live out your lifestyle, you can't just withdraw $6,000 from that traditional IRA. You need to pull about $7,900 to net $6,000 after taxes. That's 31% more strain on your portfolio every single month. We've watched retirees discover this reality 5 years in, when their withdrawal rate has crept from 4% to 5% just to maintain the same lifestyle. The portfolio they thought would last 30 years might only last 20. Your specific tax situation determines the exact numbers, but the principle remains. Know what's actually yours before you build your paycheck strategy. Part 2, endurance. Past the one-day crash. Picture retiring in January with that $1.6 million we just calculated. By March, we're in a bear market. Your overall portfolio, not just stocks, drops 15%. You're down to $1.36 million, but your bills still need to clear. Can your monthly paycheck survive? Here's how we stress test this. First, separate your safe money from risk assets. Maybe you've positioned 2 years of expenses in cash and short-term bonds. Call it $150,000. That leaves roughly $1.5 million in a mix of stocks and riskier bonds. In this scenario, your stocks might be down 25% while bonds are flat. The blended 15% drop takes your total $1.6 million down to $1.36 million. Now the critical moment. If the market doesn't rebound for a few years, where will your monthly $6,000 paycheck come from? If you're forced to sell equities that are down 25%, you're locking in permanent losses. Selling shares at the bottom to buy groceries, that's how retirements fail. But if you can pull from interest, dividends, a bond ladder, or your cash buffer without being forced to sell stocks while the markets recover, you pass the endurance test. The key here is not going into retirement with too much of your nest egg in the stock market. We see people retire with 85 to 90% or more in equities, thinking they need growth to get them to a safe retirement number. But depending on your specific case, that aggressive asset allocation can destroy your potential endurance. You simply haven't set aside enough stable assets to fund paychecks during extended downturns. The difference in outcomes can be dramatic. The retiree forced to sell depreciated assets each month to fund their lifestyle typically exhausts their funds 7 to 10 years earlier than someone who built in proper endurance. Sequence of returns risk isn't just bad luck, it can expose inadequate planning. You can't control when markets crash, but you do have some control over how soon that crash would force you to sell. Of course, every situation is unique, and what protects one person's cash flow might need adjusting for another. Part 3, order. Decide the withdrawal playbook. We've covered ownership, endurance, and now order. Which accounts to tap and when. This is where preparation separates successful retirements from the rest. You need a predetermined hierarchy for which accounts fund your lifestyle in different market conditions. No emotion, no second guessing, just execution. Here's the framework we typically use. In up markets, we consider pulling from taxable accounts first. You're selling high, rebalancing and harvesting gains at favorable prices, paying preferential capital gains rates, and keeping ordinary income from IRAs low during your Roth conversion years. Your existing Roth IRA balance can grow tax-free for later or for heirs. Flat markets shift the strategy. When markets drift sideways, we often tap traditional IRAs for income, especially if you're in a lower tax bracket early in retirement. In this case, you're paying the tax bill gradually instead of getting forced into higher tax brackets later with required distributions. Down markets, this is when withdrawal order really matters. We pull from cash reserves and live off our bond ladders first, then dividends and interest payments. Anything to avoid selling stocks while they're down. Some retirees use market downturns to do Roth conversions, turning the crash into a tax opportunity. The wrong withdrawal order can cost you 5 to 7 years of retirement security. We've seen people drain their Roth first because it's tax-free. Except that Roth with their hedge against future tax increases and market volatility. All that tax-free compounding potential, gone in the first decade. Or they'll consider tapping their taxable account in a down market, which might also coincide with a low tax year, while their IRA RMDs force them into higher tax brackets later. A missed opportunity to settle up with Uncle Sam on some of the inevitable tax on your IRA account while tax rates are relatively low for you and possibly for our country overall. Remember, this spending order framework is designed to proactively minimize your total lifetime taxes paid. It adapts to your specific accounts and tax situation. What matters is having the plan in place before you need it. These 3 parts, ownership, endurance, and order, form the complete cash flow test. If your retirement passes all 3, returns really do become the bonus, not the lifeline. To continue building your retirement plan with these concepts, click the first link in the description below. There are free worksheets and calculators, plus a transparent overview of our planning philosophy. You're also welcome to stick around for more videos. Whatever path you choose, I'm glad you're taking control of your retirement income.